All right, well, those are the big headlines we'll be tracking for you all evening today on ET Now. Well, let's kickstart, the show and get on board a very special guest. We have with us Parizad Sirwalla, National Leader for Global Mobility Services Taxation with KPMG. Parizad, the pleasure having you with us today on ET Now. Before I get into the whole process of income tax return filing, about how we just have 3 to 4 days to go, and of course stressing on how it's just become a much more easier process, let's first talk about something a bit more recent that has already happened. Major companies of India Inc. have announced buybacks, which means essentially they'll be buying the share owned by the public shareholder back from them and paying them a certain fixed amount. In TCS's case, I think it's roughly 3,000 rupees. So what exactly are the tax implications of this? Because Parizad, essentially, I'll be getting money and I have to sort of tender in my shares. So should I do that? If I will essentially be exiting my stake. So should I, do so by selling it in the share market? Should I do so by tendering it in the buyback? In both cases, how would you compare the tax impact on me, the shareholder?
Sure. So good evening, first of all. And, as you mentioned, I'm presuming we are talking of listed equity shares out here. So just sort of let's do a relative comparison on buyback versus selling in the open market. The first thing to note is that, buyback is a tax paid by the company at the corporate level. And the current rate is around 23.296% to be precise, including your surcharge, cess, so on and so forth. Buyback tax is calculated currently as per the tax laws as the difference between the buyback price minus the issue price of the shares. And as I said, that's paid at the company level and it's exempt and nothing is paid at the individual shareholder level. But let's take an example just to illustrate the point, because in some sense there could be an element of double taxation. And I would just like to, quote with a simple numeric. Let's assume there is a Mr. A who, first buys the shares of X company limited in an IPO, maybe let's say at 100 rupees per share. And then he subsequently sells it to another individual, which is, say, Mr. B at around, let's say, in the open market at a price of around 250. So in the first stage, the differential between the 250 rupees at which he sells to Mr. B minus the 100, which is, the price at which he gets it from the company, to the extent of 150 rupees, he lands up paying capital gains tax in his hands. Let's presume the transaction a little forward and say that this Mr. B now offers the shares for buyback to the company at a particular date when the price is around rupees 400, which is the buyback price. So the point being that the incremental over 400 rupees minus 100, which is the original issue price, is basically the spread on which the buyback tax is paid, and the company will pick up the tax there. So to some extent, because the first individual has already paid capital gains tax on the differential in his hands, to some extent, therefore, there is an overlap or double taxation in this case of a buyback. To your question on whether, selling in the open market is better or, the buyback, it so happens that at times in a buyback, the companies typically adjust the buyback price also to accommodate the tax impact that they have to, bear. Vis-a-vis that, if I contrast it to selling in the market, again, it depends on the period of holding. If you are talking of a listed equity share, if you held the share for around 12 months or so, then it's long-term capital gains in your hands as an individual shareholder. And if it's, less than 12 months, it's short-term capital gains. And of course, the rates of tax are different for long-term and short-term. As an example, long-term on listed shares over and above 1 lakh per annum is now taxable at a rate of 10% plus surcharge and cess, and short-term at 15%. So to summarize, it's very relative to the facts and circumstances as to which is more tax beneficial, because it depends on a number of factors: the period of holding, the cost of acquisition, the buyback price, and whether the company is going to adjust, in terms of the buyback price to, accommodate the tax impact. So long answer, but very relative to facts.
Well, of course, I understand it's a very different impact for different people. It depends on several things. And yeah, that's largely all about taxation on buyback versus taxation on open market sale. Another thing that we saw recently was dividend, very hefty dividend by one IT major, and this is again something that pops the question for a lot of shareholders that, okay, if I'm getting such a big dividend, how is it going to be taxed in my hands? Now there were a couple of changes as well in the taxation of dividend in the last in the last budget. So if you could just sort of spell that out for us, Parizad.
So last year, if you recollect, during the time of the budget for the financial year 19-20, you're very right. Dividends were effectively, doubly taxed because there was a dividend distribution tax in the hands of the corporate declaring the dividend roughly at around a rate of 20.56%. And then what used to happen was in my hands as a recipient of the dividend, if I was in receipt of dividend about 10 lakhs, then I was in turn taxed in my hands also as a shareholder. So that was, creating some anxiety levels. But from this year onwards, which is for the financial year 1st April 20 to 2021, that has been remedied. So now dividends are completely taxable in the hands of the individual who receives the dividend and not in the hands of companies. So effectively that double taxation has been removed. There is no dividend distribution tax, but of course the huge amounts of dividend that I receive is going to be taxable in my hands as a recipient of income. So that is now, taxation at an individual level. And of course, if the dividend income exceeds around 5,000 rupees per annum, then the company will also deduct the TDS and give it to you in your hands. But basically, it's taxable now in my hands as an individual recipient.
All right, so that's with respect to taxation on dividend. There's been a lot of corporate action, especially on buyback, of course, more than dividend, but especially on buyback. So I hope this gives all of our viewers, a bit of a gist on what they can expect, which could be, and taxation as well could be an important factor in making your decision on whether you should tender in your shares in a buyback or not. So I hope this has helped all of our viewers. Okay, let's talk now about the return filing process. Parizad, we just have a couple of days to go, and even though I see Twitter and other social media handles inundated with requests to the finance minister that, please just extend the deadline once more. At the same time, I think a lot of people have been getting emails that reminding them to file their income tax returns. So let's start off first with the entire filing process. Some people find it extremely daunting. They rather have their accountant do it, but accountant may be unavailable, maybe holidaying for the New Year's Eve and what have you. So if you could just sort of walk our viewers through what's the process like now to file your income tax return. Has it become easier? I see, a jhatpat filing, announcement as well by the department. So just how does it work essentially?
So actually this year, on account of the pandemic, the deadlines have been, suitably extended. For individuals, it was earlier 31st July, which has now been stretched up to 31st December for those who are not subjected to tax audit. Relatively, everything is digital. So it's a pretty, I would say, simple e-filing process, which was there last year as well, wherein you obviously have to, register for the first time and have your login details. And once you do so, it's simply about selecting the right income tax return form to pick and choose. And you have various functional utilities on the income tax portal. Everything is very self-explanatory. And, depending on your streams of income, your threshold of income, there are various forms from ITR 1 to 4. In salaried individuals, let's say as an example, up to 50 lakhs of income, having only one house property can technically fill the simpler form, which is ITR 1, so on and so forth. People who have capital gains or business income, there are different income tax forms to pick and choose from. The process is it's a step-by-step, clearly explained on the portal itself, and everything is electronic. And once you have all your, relevant documents ready, your calculations, you can simply upload the return form on the income tax portal itself and then, e-verify it. Of course, you need your PAN and Aadhaar interlinked as well. But sum and substance, it's fairly, I would say, to a large extent, much easier than what it was earlier. You also have at times the government pre-populating your returns with certain preloaded information around your basic details, so on and so forth. So I would say overall, simple process. Portal is very, easy to use and quite self-explanatory.
Parizad, is different in this year's return in terms of maybe additional disclosures or any extra data that the government requires, which was not there in the case when we were filling out our previous returns? What are the new disclosures?
So to a large extent, the detailed forms on disclosures were out last year. So for instance, now they call for a kind of a balance sheet. So all your assets and liabilities, wherever, if you're a resident of India, then you not only have to disclose, there are schedules called AL for all your domestic assets. There's a schedule called FA, which is all for your foreign assets if you're an ordinary resident of India. There are very detailed schedules depending on the asset class that you own. Largely, the disclosures are similar like last year. For instance, if you hold a joint house property, you have to go about disclosing the names and PANs of the joint holders. If it's rented out, then tenant details also are called for. This year, on account of the COVID pandemic, they have allowed in any investments that you made from a tax saving perspective for the period 1st April 2020 to 31st July 2020, the regulator had clarified that you can go about claiming the tax breaks either in your March 2020 return or in your March 2021 return as you choose to. So there are schedules for disclosing that as well. When it comes to your detailed capital gains schedule, again, if you have capital gains, then there is a disclosure requirement for individual scrip reporting in your capital gains schedule, particularly if the purchase has happened prior to 31st Jan 2018. Last year, I think they had permitted a consolidated reporting of capital gains, but this year they have called for individual scrip-wise reporting. So for those people who have large number of sales transactions or capital gains, they might have to factor some bit of time. So every year the disclosures definitely get more granular, but there is not a material difference in this year's forms over last year's forms, I would say.
Okay, understood. Let's now understand, and this is just so that our viewers are aware of the importance of filing your income tax return. Parizad, firstly, why does one need to file their return? Secondly, what are the repercussions of not filing your return in time or at all, even worst?
Yeah, sure. Sorry, before I cover that, just one point I wanted to respond in response to your earlier question, that they've also brought about these transaction criteria. So if you spend sort of, more than 2 lakhs on foreign travel, if your electricity expense is about 1 lakh in a year, or if you deposited more than 1 crore in a current account, then those people also have to file returns, and there are, these specified transactions also have to be disclosed. Sorry, that was just one point in response to your earlier question. In response to the current question as to what happens if you don't file your return, well, first, of course, you have late filing fees, and, if you have any tax dues, then you'll have interest and penalties payable. However, let's say you have certain, losses that you wanted to carry forward. Let's take an example of a capital loss that you have of last year, which you want to obviously carry forward, and it will, be used to offset your subsequent capital gains, if any. You lose that right if you don't, file your return. And sometimes, of course, you'll get questions if you file your return late from the tax department if they choose to ask so. Particularly if they notice that you omitted to, some stream of income and you file your return late, it may not just augur well for them. But largely, you lose the right to carry forward your losses, and you will, of course, unnecessarily incur any penal interest and, late filing fees.